on capital intelligence, where we'll talk about the right money, finding right formats. I would love to invite the session lead and moderator, Ms. Punita Kapur, Deputy Editor, Entrepreneur India, to please join us on stage. Ms. Punita Kapur, let's hear it loud together, everyone. Please welcome her with a big round of applause. I'd also love to invite our speakers on stage. Please welcome Mr. Tarun Khanna, Partner, CX Partners. Let's hear it loud as we welcome him. Mr. Tarun Khanna, everyone. Mr. Karan Makan, Founder and General Partner, Quantum Oakmen Partners, to please join us on stage for this next discussion. Mr. Vishal Jindal, Founder and Co-CEO, Biryani by Kilo, joining us on stage. Let's hear it loud as we welcome him. And Mr. Karan Kapur, ED, Hospitality Corp, joining us online for this next panel discussion. And with this, I'd like to hand it over to Punita.
Thank you so much. A very good afternoon, ladies and gentlemen. I'm sure you must all be hungry because it's the last session before lunch, but we'll ensure it's worth the wait so that the session is more interesting for all of you. We have an interesting topic being discussed here about capital investment, which of course forms the basis of any restaurant, and when you want to scale up further the operations, it makes the basis of that. And I have an interesting panel with me. So 2 investors plus 2 entrepreneurs. And that too, one who is from the private equity space and another one from the angel investment space. So I'll just give the mic to each one of them to briefly introduce where they invest and what kind of business they run, and before we further get into the discussion mode. So I'll first hand it over to you, Tarun.
Thank you, Punita. By way of quick introduction, I'm part of CX Partners, which is a growth-oriented, India-focused private equity fund. We look at 4 sectors: healthcare, consumer, IT, technology, and financial services. I look at the consumer vertical. Within the consumer space, we made a few investments over the last 14, 15 years, largely focused on F&B. No real reason behind that. Maybe we just liked some of those businesses. We invested in Barbecue Nation in 2013. Then in 2015, we invested in Mrs. Bector's Foods, which has the breads and biscuits business under the Cremica brand. Both these businesses have gone public in the last 18 months. Then again in 2015, along with Samara and Goldman, we consolidated 7 different franchisees for Yum in South and Central India, Pizza Hut and KFC stores. So that's also gone public about a year ago. And recently, well, it's been 3 years now, in end 2019, just before the pandemic, we invested in a fast casual dining restaurant chain in the south called Dindigal Thalapakatti. The hero product there is biryani. So these are the 4 F&B businesses that we have invested in. Yeah, so that's a little bit about us.
Al?
Yeah, thanks, Tarun. I think Tarun is a veteran in F&B investments. We have the greatest respect for Barbecue Nation. I think it's, I would say, the only Indian chain to become 1,000 crore plus in around 80 cities. So it's not an easy thing to do them. So I'm the founder for Biryani by Kilo. We have more than 100 outlets in 45 plus cities and close to, if I can say, 250, 300 crore ARR. We are a pan-India biryani and kebab delivery chain primarily, and we have select dine-in in these 40 cities as well. We are the only company to make fresh biryani in handi for every individual order and deliver or serve in the same handi. And of course, we have great kebabs, curries, and finny as well. I'll encourage everyone to try if you've not tried. So we are quite passionate about this business. Like I always used to think, why don't we have a Chipotle or a McDonald's from India, worldwide chain? And biryani is that dish or cuisine which travels very well in delivery. It's a one-pot meal, very versatile, more aromatic and flavorsome than a burger or a pizza, gluten-free. And it's a very delivery-friendly category, and it has been sold for a few hundred years. The mind share is there. There's no incumbent leader, unlike a burger or a pizza like Domino's or a Burger King. So we are clearly, if I can say that we are, without sounding arrogant, that we are clearly the leaders in 45 cities with that kind of a run rate and acceptability across north, south, east, west, tier 1, tier 2 towns. And we intend to make it a 1,000 crore brand in the next 3 years and take it international as well, with the kind of SOPs, process systems we have built around the brand, which is I think the most important things in F&B brand. Yeah. Thank you.
Sure. Hi. Good afternoon, everyone. We just got a little delayed from our planned timings, and really glad to be part of this panel where we have veterans from the industry. I am Karan Makan, and I represent Oakmen Partners. We basically invest into companies in the early stages, and most of our brand portfolio consists of brands that are into F&B, expanding pan-India. We are working around brands that are tier 2 or tier 3 centric, because that's where the growth is happening at the Indian level. And looking forward to this session. Thank you.
Hi, Karan. Good to have you online with us.
Hi, Punita. Can you hear me?
Yes, absolutely.
Super, and thanks a lot. Apologies I couldn't be there in person, but really happy to be part of the panel as well. Just a quick brief, I guess, on us. Company's name is K Hospitality. We've been now, this is our 50th year of the company. So we've been in F&B since 1972. Originally started with a single brand called Copper Chimney. And today we operate across multiple formats, whether it's QSR, restaurants, bars, banqueting, catering, food courts, corporate food services as well. We're roughly in around 19 cities now, and we operate about roughly 500 different outlets. So we're a bit different in terms of we're multi-brand and multi-sector as well, or one vertical in the F&B industry. But very much, I think principles are quite aligned. So thank you for having me as well.
Karan, I'll start with you. And so we all know that you have invested in such iconic brands, whether it's Sapphire Foods, it's Barbecue Nation, or Mrs. Bector. So I wish to understand, when you invest at a scalable stage, I mean, what kind of growth do you add as a PE partner to that company?
Good question. So we are not, early stage investors. We like to invest in a business that is already a proven format. So, for example, when we invested in Barbecue Nation in 2013, I think they had about 26 or 30 odd stores, roughly about 180, 200 crores of revenue at that time, which, I mean, in today's term, that will translate to about 400-500 crores. So proven format, proven model, profitable, cash flow is there. So what were they looking for in a private equity partner? A, they were looking for capital, which is fine. Today, capital pretty much is a commodity. But more than that, they were looking for someone who could help them, for the lack of a better word, let me say professionalize. Now this word professionalize has been bastardized a lot. Everybody just uses it without, at times maybe I also use it without actually knowing what it means. Most businesses, entrepreneur, promoter-driven businesses, we like to label as Lala businesses. What is a Lala business? Lala business basically means that there's a guy who's running the show. Everybody who works for him doesn't have the same IQ level as him. So they're there for directions. He tells them what to do and they go and execute. All the thinking happens with the promoter. At times the promoter is good, they can take it to the next level, at times they're not. And the business is limited by the promoter's mindset. That, to my mind, it's not a bad thing, by the way. It's a very good thing. But what does professionalizing mean? That you, along with the promoter or the entrepreneur, will have equally capable people running operations, running finance, running brand marketing. And every month they will meet and they will have an intellectual discussion about what they did. And everybody around the table will objectively assess whether it is the right thing to do or the wrong thing to do. That kind of a discussion, an objective, thoughtful discussion, does not exist in a promoter-driven company, no matter how well it is run. To my mind, that is the definition of professionalizing. So I'll give you an example. Barbecue Nation, when it opened stores, this is in 2014, long time ago, there were 2 stores in Delhi. They went from 2 to 11. They opened 9 more stores. So I wanted to understand the logic and the thought process behind it. The logic was that everywhere else we've got 6 or 8 stores. Delhi is a big market, underpenetrated. Let's open stores. Now, you can never challenge an entrepreneur's wisdom because they've been doing it for donkey's years and they will continue doing it. You are basically an investor that comes in. But they were right. Today, NCR is, I think, 32 stores. It accounts for, I think, about 25% of the revenue, very profitable and all. But I wanted a science around that. So understand how many catchment area there are in NCR, how many brands are there, what is the pricing, where should you compete in terms of pricing, etc. That is a very data-driven, objective way of running a business. I think that's the most important thing that we look for when we invest in a business. We take a business which is mid-size and take it to the next level by distributing and empowering at least 10 to 12 people whom we call CXOs, whether it is head of operations, head of finance, head of marketing, head of production, head of procurement, and trying to de-risk the business from these kind of eventualities. I think that's the main thing that we look to do in a business. Sorry, I took too much time.
Vishal, you sit on the other side of the table. So when you went looking for funds, for external resources, what kind of growth it brought to the business? And
Say again?
I'm saying when you went out looking for external investment, what exactly did you look for when seeking the right partner?
Of course, people like Tarun. But I hope we are not running a Lala business. And so it's quite a professionally run business. Like some of the HODs make more money than me. So I hope it's professional enough by that metrics. And we have similar meetings like Tarun is saying, and once a week with all the HODs. And it's more than objective discussion. I don't think I have the last voice at any meeting. So in terms of partner, of course, like I think what Tarun said, I think I entirely agree, completely agree with this. First, of course, the money. And second, if I can say a long-term vision. So of course, people like CX or someone who has had the experience of doing it in the past knows maybe how to professionalize it even better than what we might know. But a long-term vision also is required, that partner is not completely hands-off. It's hands-on, and which is welcome. And they have a long-term vision in terms of creating a sustainable brand, which hopefully would be there for another 50 years. Like in food, McDonald's has been there for the last 50, 60 years, and hopefully would be there for another 50, 60 years. So these brands are made for hopefully, if not 100 years, 50 years. So a partner who's invested in that long-term vision. Yep.
How many times have you seen that an investor would challenge the mindset of an entrepreneur in terms of scaling further, in terms of growth?
All the time, all the time. See, there's no real passive investors here who've given the money and who will not challenge. So I think it's every board meeting, every time. So I think that is very welcome. It's all the time.
Any instance which you could share?
It's almost like every month, like everything. Let's say today we have one dine-in outlet per city, which also is a cloud kitchen. But so we wanted to, let's say in a city like Dehradun or Jaipur, we wanted to do a dine-in outlet as well. You know, so Chandigarh was our first dine-in outlet. I remember 4 years back, and so there's, of course, different views of investors that we shouldn't do dine-in. But I think we believe that omni-channel presence is very important. Although we are, dine-in is 10% of our business, but that 10% is important for brand to be seen, especially in tier 2 towns, if I can call them tier 2. And the rent as a percentage of revenue for us, even in those towns, is 6% or so, which is okay. So, and we don't do very big dine-in outlets, but that gives us a brand connect. We would also like to maybe next year go to airports, food courts, but within that 10-15% business dine-in. But so there was a difference in opinion. So, but I think in the long run, I think it has helped us.
Karan, coming to you, you've already made more than 12 investments, that too in the food space only. So over the investment, I mean, what kind of formats have you seen which are growing at the moment in the food space?
Yes, absolutely. So when we talk about food space, cloud kitchen is something that came up post-COVID, and people started realizing that that is going to be the way forward. But in last 12 months, or I would say in last 3 quarters, there has been huge growth in the cafe model or the casual dine-in model. The reason being, a lot of workforce went back to their households, went back to their hometowns to work from homes for all these corporations. So that there was a lack of brand availability at that level. And whenever a brand is reaching with a dine-in format in those cities, that is getting huge and a great response. Whether it's international brand like KFC in a city like Mandya in Karnataka, or Pizza Hut or McDonald's for that matter.
Forward, which would be the formats you will be investing in 2023?
Again, hybrid is the way forward, where we are able to run multiple brands, I would say, from the same kitchen. Eventually, that helps us in decreasing the operational expense, as well as if we are able to streamline the processes, following the strong SOPs in place, that helps us in getting good sales, higher profits, better returns eventually for us as an investor, and good profits for the restaurant owners.
Karan, coming to you, I mean, we've all seen K Hospitality being in the market for last 50 years, and it's no small feat keeping the brand relevant for so many years, almost half a century. So when you go out and look for external funding to further scale the brand, what kind of options do you look for, and what kind of added value they bring to a brand like K Hospitality?
Sure. So I think, Punita, so we of course have, diverse businesses. We've got 6 different verticals, which are there. So I think, each we really look at it, I think somewhat like how Tarun may look at his investments, but we kind of follow a similar approach where we really look at from a private equity mindset, in terms of capital allocation, growth, return on capital in each of these verticals. And so, when we're thinking on decisions on which to expand, what's the right way to look at funding, I think it really depends on the business. It might be very different when we're looking at our travel retail business versus looking at our Indian formats versus looking at maybe, our corporate food services vertical. So what we've done, I think historically in the past, which I could share just in terms of growth, is, I think, one, as an entrepreneur, I think there are few layers of funding which you can look, right? I think most entrepreneurs starting out, and if I really go back 50 years, if I look at where my grandfather started, he would have started with friends and family. And that would be usually a funding mechanism most entrepreneurs start with. As time kind of went on, and I'm just charting over the years, I think there wasn't private equity, there weren't that many strategics, it was a different world. So I think bank funding, debt became another option where you do it, but you had to be careful, right? I think there are enough stories of companies which have got over levered or scaled too fast along with it. And F&B it's a great business, but it's a challenging business. A few bad outlets can set back the business as well, just given investments and so forth. So I think that became another route which we looked at. What we've done, so we don't have any private equity at the moment in the business, but we did for one of our verticals bring in a strategic. So about roughly around 6 years ago, we were looking at raising funding for the next phase of growth for one of our businesses, and so we had a final term sheets between a private equity and a strategic. Both had completed due diligence, so we finally decided to go with the strategic. And we've seen that's worked extremely well. Now finding strategics in our industry also, there aren't too many who are investing and doing things. So we do some investments, for example, as K Hospitality into some businesses where we keep evaluating opportunities. But primarily, strategic can work, and there are pros and cons to both decisions. I think it's really up to the entrepreneur in terms of what are they looking for. Is it capital? Is it assistance on the business? Is it business development? And so I think it's just figuring out what's right for your business, and ultimately the right relationships are important as well, because it's ultimately a partnership. So based on that, I think you can take one or the other as a call.
Come back to you again. Tarun, coming to you, we're already seeing a certain kind of slowdown in the investment space. So what is your view in the coming year? What kind of formats will get funding during those economic downturns?
Yeah. So what we've seen after COVID, maybe over the last 6 months, there's a general slowdown in the market, not just in F&B, FMCG, staples, commodities. People are buying less. People are buying less, and the ones who are buying are down trading. So instead of buying the more expensive product, they're buying the cheaper product, and they're just postponing their purchase. So that's pretty much prevalent all across the market. What category or what product will be able to raise money over the next 12 to 24 months? In the restaurant space, it's a function of two variables. First is the product. The other is the format. So you've got fine dining, casual dining, fast casual dining, QSR, delivery, cloud kitchens, and you've got a whole bunch of product. Now, I think because of the surge in the last 3 years, we kind of lost sense of product. Product, to my mind, is the single most important thing that keeps a restaurant business going. Like Vishal said, Biryani by kilo, has aspirations of becoming 1,000 crores, going overseas, all of that stuff, which is great. But when you think of biryani, you should think biryani by kilo. Like when you think of burger, no matter how bad their burgers are, you always think McDonald's. When you think of pizza, think Domino's. So they're synonymous to the category. And how do you become synonymous to the category? I don't know how many people here are from Delhi, but if I mention Pandara Road or Have More, you will say butter chicken. Okay, I'm 52 years old, I grew up on that. And butter chicken in my mind is Have More. When I say Nirula's, you will say hot chocolate fudge. Nirula's doesn't even exist today. It's finished, right? But it's edged in your memory. Product has to be very differentiated, and it has to be consistent, and it has to be top quality. One of the restaurants that I visit in Delhi is Olive, next to Qutub. It's been there for some 25 years. Fantastic. It's full every day. Why? Because the product is very good. They don't compromise with the chef. Just because the restaurant is working doesn't mean you know, replace the chef and bring in a subpar chef. They keep improving the product. They keep innovating on the product. That is the most important thing. The product has to be fantastic. It has to be differentiated. People have to come to the restaurant for the product, stay, come back again for the service. That's the most important thing. Product has to be differentiated. Format has to be capital efficient. If the format is not capital efficient, then, I mean, people will take their capital somewhere else. And by capital efficiency, I would mean 3 years, 3-year payback. 3-year payback, I think is, I mean, in your case, is much lower, but 3-year payback is okay. 25% IRR is what you make in 3-year payback, which is decent. I mean, if you have 1.5, 2 years, fantastic. But a 3-year payback is decent, great product, scalable, and it should be able to stand the test of time. That's, I think, that's the model that will get funding.
Vishal, coming to you, there are a lot of people out here who are actually looking for investment in the restaurant and food space. So what would be your advice to them from your fundraising journey?
No, the same thing what Tarun said, you know, we're on the same page. I think product is the hero. So it has to be a differentiated product. It has to be a consistent product. And it has to be capital efficient. I think as long as you have that, you will have investors. So when I repeat, if there is a consistent product, good product, differentiated product, like you said, if you can return the money of any outlet in 2.5, 3 years, and it can be taken at a scale, you know, consumer businesses in India are there to have a massive growth in the next 7 to 10 years. So there's nothing, but it's easier said than done. First of all, a differentiated product, then differentiated and yet consistent. And number 3, capital efficient. And it can be, I will add one more thing, can be taken, because a lot of categories in India, you can't really scale that much because of the depth of the competition. So you can clearly demonstrate it can be made 1,000 crore plus business. So you will, I'm sure you will not have a dearth of investors.
And I would like to add a point over here, like obviously, and it is a necessity where PMF, product market fit, should be there. But what I have seen, like working closely with the founders, it is also important that we have the right FMF, founder market fit, because even if the product dwindles, even if it enters newer territories, if the founder has the conviction that he has to make things work, things will work out. And this has been my experience. Like we ventured into a new market of Mysore. That was one of the ice cream brands by the name of Cremon. First month sales, we crossed like 17 lakhs. I don't think any ice cream brand will be able to do that in terms of a monthly run rate. So founder has to keep his heads up, and FMF is something that I personally look into, that the founder should have that conviction so that he works with his headway forward.
Karan, you typically invest at the seed stage. So at that stage, I mean, what exactly do you look for when investing in a brand, and how do you support them in the journey going forward?
Again, the kind of brands that we have invested is something. All of them were founders who had done a couple of ventures in the past and may have failed. So there were a lot of learnings that came with them. And again, a concept that is driven. People nowadays not just focus only on food. They want something very Instagrammable. The consumer, so food is also something directly correlated to the consumer products. It is something that people directly have it, and you get the experience out of the consumer right away. If the food is spicy, they will just immediately give you the feedback. So it's an industry that's highly appreciable, and it appreciates the restaurant immediately. And that's how brands generally grow. So coming to your question, like founder is something combined with the right concept is what we look out for. And with our on-ground efforts, we have been able to take help of our research reports and have seen that along with food, there are industries like entertainment or real estate is again booming very fast in all the tier 2, tier 3. In all my interviews, you will hear this a lot, where I keep mentioning the kind of business that is going to come from tier 2 and tier 3 cities. So I see India as a country of countries. We are not just states. Each state has a potential equivalent to any other country in the world. And that's the kind of magnitude, and that's the kind of economics that will come up very soon. You will again see businesses that still don't exist as we speak today, and they will be making a strong mark as soon as 2025.
Karan, coming to you, there was an announcement which came from the group recently that you'll be investing close to 500 CR, if I'm correct, in the market. So, I mean, will we see more acquisitions from the group?
So Puneet, I think our focus around from a capex perspective next few years is more really towards our own formats. I think we are going deep into, for example, one of the big opportunities we see is on the highway side. We're scaling up quite rapidly with highway stops. We did a pilot pre-COVID. Just want to test the model, figure out the investments, return on capitals, etc. And that's been quite successful for us. So we've got now already roughly around 15 in the pipeline, which are coming up there. We do believe that will ramp up even further. And second area where we're investing quite a bit is on the QSR side as well. So from our business, we've been multi-brand, but largely, if you say majority of our businesses from a format perspective are QSR formats, either our own brands or franchises of brands. So we're planning to now build on our side. So we've launched a new format called Josh, which is on the Indian QSR side. We've just opened up the first 5 stores. So been quite a good response at the moment with that. So we're looking to really invest and grow that over the next coming years as well.
Our audience, if you could share one learning with all of us in terms of keeping yourself relevant for so many years.
Yeah, I think I'll give you actually a great example is Copper Chimney, which is there. I mean, it's maybe people know us most by Copper Chimney, even though maybe from a business perspective, it might be the smaller part of the business. But with Copper Chimney as well, I think we've heard over the years and different trends about Indian food, traditional Indian food, and how modern Indian is coming to age and fusion food. You've heard all these things in terms of trends. Honestly, the brand's only grown from strength to strength. I think, as of last month, we've done record numbers, highest for many stores we've done in decades. So you're seeing the trend every year with same-store sales growth really picking up. And I think what we've seen, I think it just comes back to the basics. I think Vishal basically alluded to it very briefly in his comments where he spoke about consistency. And I think sometimes that's the easiest thing to say, but to deliver on that year in, year out is very difficult. I think you can ask all of us F&B guys. And it's been challenges in the past which started with maybe on the supply chain side, it may have been the store processes, it may have been training. There's a whole host of activities which go into delivering that consistency. And honestly, I think everyone's working to get it right. We talk about McDonald's. The Filet-O-Fish burger may not be the same every time you go as well. So even a McDonald's sometimes has challenges with consistency. As much as I'm the biggest fan of McDonald's, I love it. So I think it's just about, getting that piece right to the large degree. So you can get to a 90-95% level. We're able to deliver a consistent product. I think that really holds strong. Don't compromise on quality. And lastly, I think look after your people, because ultimately they're the ones serving your guests and looking after them. So I think if you get these 3 basics in place, I think relevance and continuity goes on. And of course, Tarun mentioned about innovation and obviously listening to your customer. But I think sometimes that gets overblown by media talking about new trends and new things. I think the innovation, like Tarun said, is just you're listening to your customer, seeing what they're saying, look what they're looking for, and just keep adapting and evolving with the times, as opposed to look to really read something in the paper and try to reinvent your concept every year.
Before we close the session, Tarun, one learning from you in terms of...
I think the learning in the F&B space, like Kunal said, you cannot build a brand without consistency. You can have a a restaurant chain with 5, 6, 7, 8 stores, good cash flow, very profitable. But if you want to build a brand, you want to take it to 50, 100, 200 stores. Brand by definition means consistency, right? What does a brand mean? That the same product, different days, different locations, tastes the same, has to be consistent. So when you scale outside of a city or outside of a scale or state, keeping the brand consistent is extremely difficult. I think the session before us, somebody from the audience mentioned that growth and consistency don't go together. It's absolutely correct. Anybody you speak with who has got anything to do with restaurants will say that it is very difficult to grow. Very difficult to be consistent if you grow. So consistency of your product is the key to maintaining your brand, which is the key to survival in this industry. Because every 6 months there'll be a new concept, new restaurant that'll come up. So how will you attract the same customer to come back? Consistency, brand. That's the most important thing. Do not grow at the cost of your product or consistency. If your product cannot be consistent, do not grow. Remain with 10 stores. That's the most important learning, which I think across the F&B space, he's done very well because, by the way, he's not a lala, he's an entrepreneur. He's a professional who turned entrepreneur. He runs a business very well. And he started his, sorry, I'm answering the question for you. But he started the business based on certain SOPs of consistency. His product is such, he's saying, I'm going to take this product intercity, interstate, inter-country, and thinking 4 years ahead, saying, how can I keep it consistent? Only then will I make it like that. So the way he makes his biryani is very different from everybody else. He cooks to order. He doesn't cook to plan. So he does a fantastic job.
Vishal, you want to add to it and share the secret sauce with us?
No, I think I'll just say thank you. I think nothing. So I think I'm nothing more to say but to repeat. I think a differentiated product done consistently, I think is a great line.
So Karan, any parting thoughts for people who are seeking investment?
Yes, so you have to hit the markets. There is no alternative to that. Every market has a different kind of reaction to the product you put in. And to all the entrepreneurs, I would just tell them to start right away and get into the market and try to get that PMF as we discussed. And again, that PMF will only come if we have the FMF. The founder needs to have that conviction to get to that perfect product and hit the market, get the data out, work on it, improvise your product, give to the customers what they want, and that's how we will be getting a fantastic output.
So with this, we come to the end of this session. Thank you so much, the audience. Do we have time for questions?
We don't, but we can certainly take the questions offline, if that works.
Okay, we'll take the questions offline. Thank you so much for being such patient audience. Thank you, gentlemen. Thank you, the panelists. Thank you, Karan, for joining us.
Thank you. Thanks, Punita. Thanks, everyone.
Thank you, Punita. In fact, I'll request all of you to please stay on the stage. We'd also like to thank Mr. Karan Kapur once again for joining us online. Can we please get the mementos? Ladies and gentlemen, for this wonderful, wonderful session with so many of insights, we'd like to thank our panelists once again. And for moderating the session, let me thank Punita. And let's hear it loud as we present the memento as a token of love and respect from us. Let's hear it, everyone. Mr. Tarun Khanna, thank you for joining us. Mr. Vishal Jindal and Mr. Karan Makan. Thank you so very much for joining us today.